Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing new Oriental stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 12 billion market cap. They're trading at $71 a share and they have 165 million shares outstanding. New Oriental Education and Technology provides educational services in China. The company operates through four segments: educational services / test preparation courses, online education, overseas study, and educational materials. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. 700 million of free cash flow in 2021 looks decent, 16% margin. Then a big negative 1.4 billion in 2022. Looks like a rough year. Revenue did go down a lot from 21 to 22. But you can see revenue was down even more in 23, but positive 800 million of free cash flow. That's a nice pivot. Really good margins of 28%. Then it went up to 1 billion. Still pretty good margins at 25%. Net income is the profit or loss on the income statement's revenue minus expenses. That has a similar trend. Positive in 21, big negative in 22, then positive in 23 in the trailing 12 months. Lower margins, 8%. They only converted 8% of their revenue into net income. Revenue is the sales for the company, and that went down a bit from 21 to the trailing 12 months, but it rebounded nicely from 23 to the trailing 12 months, up 35%. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 23 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $19 billion. We divide that by 165 million shares. And we get a calculated stock price of 115. They're trading at 71, so they're trading at a 38% discount. It's a really strong buy according to the model. Do you think it's a buy or sell? Let me know in the comments. Simply Wall Street is really bullish on this one. They're at 268 a share. They say they're 73% undervalued. There are 42 companies in the same industry as New Oriental, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx out of any company in this industry. They have a good debt to equity ratio. For every dollar of equity, 20 cents of debt. They don't pay a dividend. They generate more free cash flow than anyone by far, over 1 billion. Second is 300 million. They are the largest company in this industry, 12 billion. You probably never heard of them either. Their price multiples are a bit weak. They're trading at 3 times book value, 35 times earnings. Price to free cash flow looks good at 11.5. That is better than the median average, and they're trading at 3 times revenue. They generate 4 billion of revenue. Second on this list, Graham is number 1 at 4.6 billion. That's why Graham has such a good price to sales ratio of 0.7. And EDU, that's a great ticker, right? They do have a good 5-year annual revenue growth rate, 7%. It's equal to the median. TAL is negative, so that's probably why TAL stock has been going down a lot lately. Here's their income statement, their latest income statement, the 3 months ending 5/31. Revenue is up from 860 million to 1.1 billion, so a big improvement from last year. Cost of revenue is a little less than half, 540 million. Marketing 200 million, G&A 375 million. So total expenses 1.1 billion. So even though their revenue is up a lot, their operating income is down a lot. It went from 48 million to 10 million. Net income 29 million, that's down from 40 million. So bottom line, doesn't look that great. So to summarize, I have them trading at a 38% discount. Their ranking is 8 out of 10. It looks really undervalued, but would I buy them 4 out of 10? I'm not too hot on Chinese stocks, and I usually don't invest in this industry either. Ratio is 4 to 10. It's that high because of their price of free cash flow, but the other price multiples are a bit weak. Financial 7 out of 10. And the reason it's that high, even though with their revenue going down a bit from 2021, down 6%, their free cash flow is higher than ever, over 1 billion. That's up 48%. These percentages are comparing 2021 to the trailing 12 months. Revenue is down, and free cash flow is up almost 50%. So they're doing a really good job managing expenses. So that's the end of the video. Let me know what you think. Give it a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking a link in the description below. Thanks for watching.